Steve, lots to talk about, but let's start with the news of the week in the private equity world. The public offering of Nielsen Holdings went successfully. The stock is trading above its IPO price and, in fact, priced above the range, so success all around. What does it mean for private equity? Does this signal that equity capital markets are decisively open to leverage buyouts?
Well, I'd say, Eric, you never can be decisive about IPO markets. They're somewhat streaky. They come, they go. But I think this is an important way to start the year. Nielsen, in particular, was a company we've owned for several years, along with some other firms. When we bought it, it used to have a different name called VNU. There was a lot of controversy that we paid a high price. And now, with the terrific work done by Dave Calhoun, who's the CEO, and executing a plan that we came up with before we bought the company, we've made around, for our investors, 1.7 times our money at a time when the stock market made nothing. And so I think that...
You feel good about it.
This is the type of activity that we do in private equity that justifies the reason for giving money from institutions to folks like ourselves.
Let's say the IPO window does stay open for private equity through 2011. What's that going to mean to returns from Blackstone's investors and industry returns?
Well, I think there's a steady stream of transactions that will happen. We have another offering that may be priced within the next day or two or three called Bank United, which was a purchase of a very troubled institution, where, again, a new management team was brought in with a fellow named John Kansas, and with a dramatic change in the type of loans that the company makes, and change in personnel, lowering of operating costs, which should lead to another similar good outcome. And we'll see more of these types of activities.
How many firms do you think how many companies, rather, do you think you might take public over the course of the year?
Well, that's a tough one, for us to say. We have a number sort of in the pipeline, and we'll see what happens.
How about leverage buyouts? We saw a slowdown over the past couple of years, perhaps to be expected given the scale of the credit crisis that we went through. Is that going to continue to be the trend for Blackstone, or is 2011 going to be the year for leverage buyouts for your firm? Do you see yourself being more active?
I think we will certainly be more active. The financial markets are in very good shape. Junk bonds, for example, have rallied a lot. We just did a transaction with a cost of money for just the leverage high yield of around 7.75%. There's plenty of availability of money to do transactions in a $5 to $10 billion range, and frankly, one need not do larger transactions to make them better transactions. And the preconditions are there to do a lot of interesting investments.
As you point out, the financial markets are healthy. Corporate America is certainly healthy, growing earnings at a very healthy clip. Balance sheets are in great shape, and companies have access to that financing as well. So how do you compete against the strategic buyers with valuations already creeping up? At a certain point, you must hit a threshold that you don't want to cross.
Well, that happens all the time. We look at a lot of deals, and we lose most of them to one of our competitors or a strategic. And in our business, it's all about what's the plan for the company and what price do you want to pay. And I'm never troubled when we lose. Now, one of the things we did when we started our company in 1987 is I couldn't figure out what type of investments to do because prices were high. So the only thing that we could figure out was to buy businesses with other companies to get the synergy value from those companies. And I read the newspapers this morning, and apparently, according to the newspapers, we've done that again, combining with a company in Brazil to maybe look at Sara Lee. But that type of approach is something that we've done more of than anyone in our area of the leveraged buyout business, and sometimes those deals work very well. So there's always some way to create a very good transaction.
You talked about Sara Lee. Given what's going on in food prices, is food going to be an increasingly attractive investment?
I think that's part of a greater globalization commodity play, if you will. As more and more people around the world move into the middle class in immense size, one of the first things they do is upgrade their diets. This is highly predictable. And I think in that regard, to the extent that the emerging markets continue to develop, you ought to have a pretty strong underpinning for food as well as other types of commodities.
When you look at an investment in emerging markets, say China versus India, what are the pros and cons of investing in either?
Well, I think each country is different. I mean, they're actually not growing at radically different rates, although people think China's growing much faster. India should be an 8% growth market this year, and no one ever knows. But China ought to be in the 9+ area. And it depends on the type of company you're buying, what the value proposition is, what level of influence you can have with that company, and the company's prospects on its own. And so we like to invest in both areas. India has a lot more transactions, actually, and India is a capital short country. China actually has plenty of money there, and so it's actually easier to complete transactions in India.
We ran a poll here at Bloomberg, and we found that 45% of the investors that we talked to expect there to be a financial crisis in China within the next 5 years. Do you see that happening?
I don't see that happening. The Chinese are extremely intent on having a successful country, and they have very tight controls in their banking regulation and in their banks generally. And I think they're aware when asset bubbles start to occur. Right now, that's starting in residential
real estate in China.
And they will do their best to attack that. There's very little more important in China than making sure, from their government's point of view, that their economy is growing and that unemployment is kept to a minimum. They have to absorb 10 million people a year into their economy, and they're quite focused on doing that.
But given the risks of that commodity prices present, food prices present in the emerging markets right now, plus the capital inflows, the hot money, is there good reason perhaps to be shifting capital out of emerging markets and into places like the U.S., which has seen more investment in equities as of late?
Well, in our types of businesses, it's very difficult to deploy money into emerging markets generally. In those countries, the owners of businesses don't actually like to sell their business. They're usually willing to bring in some money, as a minority interest, which has some of its own risks. Whereas in the developed world, the United States in particular, people enjoy selling their businesses and making a lot of money, which creates a different type of opportunity. So I think if you were a liquid securities manager, these types of issues would be more relevant.
All right, Steve, so good of you to join us here at the World Economic Forum in Davos, Switzerland. That was Steve Schwarzman. He's the CEO and chairman of the Blackstone Group.